as to management of the data center, does it fall under any of our newer products being implemented? Are we implementing any of the new services, or does this fall under our run business?
This is our typical digital infrastructure management business,
okay,
which is your data center management and all the good stuff which you do.
Okay.
The only variation is the value addition,
okay,
or the differentiation we are getting and why we got the order, okay, is some of the newer components we are using there. It's a value proposition.
Okay.
So that helps us get the order. So that's why I keep saying always, a lot of people keep challenging me, are you a product company or a services company? As a value proposition, some of the products we are developing, when you enable it to the services, it helps us for a challenger like us to differentiate, and that's how we do the deal.
Okay.
And this is a very large, bank, and definitely not one of our traditional banks where we've been doing business.
Okay.
And the incumbents were Wipro, and we have replaced Wipro's contract.
Okay.
So.
And so again, because I don't think it's a great thing that you've managed to like challenge someone like Wipro. That's a brilliant start. What I wanted to kind of know was blended margin broadly. Because we largely look at our run margins as on the higher.
No, see the margins are, Siddharth, see this business in India on a signed on margin will never be greater than 18%. Okay. Now, at a transformation level where we use some of these tools and technologies, delivery signs up for an upside of 2 to 4%. This is what HR will track them on. So the sign-on margin will be around 17-18%. So the first step is to ensure we deliver the signed-on margin, because the first challenge is deal sign-on margin versus delivered margin.
Okay.
It's the first milestone. And then we start pushing for optimization using some of these tools, technologies, where you move it upwards of 18.
Fair enough, but even 18 is like at least better than what.
It's definitely better. See, our current run rate, our exit run rate was 14, if you remember. Q4 was 14. So this is above our current exit number.
Perfect. Okay. The other question, and before, I'll just start this and then I'll let everyone else also join in. Right. I think the new resolution that was sent out with the new ESOP program, could you elaborate a bit on it? Because I'll frankly tell you what our discomfort where it came from it. We understand ESOPs have to be kind of granted to, especially for a younger company like ours. But there are two facets to it which kind of, I think, had us a little puzzled. So the size of the program, it's roughly around 10% of the equity, 1 crore shares out of first 16, 17 crore equity base, right? And so, when you have that larger program, the resolution largely didn't have any checks in place as to how this could be done. Like checks for my larger perspective, not in terms of whether they'll be misused, but rather how quickly or over what duration are these kind of supposed to be.
I'll give a slightly strategic view. I'll allow Mohan to expand. He's the expert. He pushed the NRC on multiple rounds before it comes to the shareholders.
Right. And I'll just add on my second query also. Yeah. The thing is, we are, unfortunately, at our valuations are at an all-time, not an all-time low, but like on the lower end of what we've historically been. I think post the capital reduction, we peaked at 117, 120 odd before we came down to this. So, it's slightly difficult to digest. If a lot of this happens at the beginning of our valuation, this thing will be diluting at a good chunk at a very cheap valuation, if I may. We could have probably done this at a better valuation in the future as well. Like if these are diluted at a future time.
No. See, I think we should probably set this context.
Right.
See, that is where it is very important for all of you understand where we are as a company. Because the biggest challenge for all of us is that, we still think we are a 30-year-old company. We're listed for so many years or whatever. This company has got a new lease of life only 2 years now, fundamentally. Okay. Post the carve out, it is just 2 years. For us to, and the challenges we face, I think, is our cost has to be extremely less compared to market. Okay? A fixed cost. So the only way we can attract talent to the company is by bringing entrepreneurship or entrepreneurship. Every employee who has to come join us will need to have a sizable upside.
Okay.
So for him to participate in this, the only instrument which we have is the ESOP instrument. So it's a very tough call to your point. I agree with you from your perspective. If you look at it from a quarter on quarter or my annual perspective, I need to keep the cost low. Now, I cannot attract talent, even if every interview I keep telling people today, when I meet, just like I said, senior people, I tell them, boss, if you could please come and join us, where you want to come and share as a management team, we are together. We are all entrepreneurs working together. In an absence of a promoter or anybody like that, the onus and accountability on the team is very high. That's point number one. Second, attracting talent to work for us is going to be extremely high. Because see, we can't just throw 30%, 40% hikes on people because they'll keep demanding. So that's the first filtration point.
Okay.
Then when prospective talent want to join us, they'll say, okay, fine, at least take care of my current run rate. Then what's my upside on my, in this, let's say we create value together. For us, that ESOPs becomes an important tool to even run this business. That's point number one. Second thing, the last ESOPs program was in 2018, I guess. 18 scheme, which was there, the ESOPs program, which has been there for so long, and which is what has been kept us going now. And now that is almost over in terms of grant, fundamentally. So for me, the way I look at it, we look at it as a total cost to company. At least the employee feels in a different way. It's kind of a cost to company, but the way I'm looking at it, it's linked. Then I'll allow Mohan to talk about the checks and balances you spoke about. So he can expand how he will manage and monitor this. Go ahead, Mohan.
Yeah, thanks, Thomas.
Yeah.
Very interesting question. Just before I go little detail on checks and balances, purely from a HR point of view, okay. As a CHRO, I look at it a little differently, not from an economic side, but from an employee side. I have to look at it. Yeah, it is well appreciated. We are at possibly a discounted rate of what actually the share value should be for whatever the reasons the company going through as of now, right? And I see this is a sweet time for me to pick up this policy actually, in contravention to the general belief, because that's when employees would be able to save value for their contributions when their ESOP value keep growing up while they part with us, while they join us and stay with us. Right. So I wanted to keep generating that interest of that value increasing while they are working with us. That's a principle why we wanted to have this timing as such. Now, going back, one beautiful suggestion came from NRC. I actually give this credit to NRC, when the entire directors have recommended this. We just replicated 2018 policy to the 2023 policy as a first step. What lacuna we had in 2018 policy, there is no performance indicator for vesting.
Okay.
Now the directors have professionally suggested us to include a performance linked vesting rule.
Yeah.
Okay. Unless an employee meets and exceeds expectation, we would not be allowing an employee to vest share stocks. While you give a allocation, the vesting rules have a limitation linkage to the performances. That means it has a direct bearing to the performance of the company. Now, the board was looking at employee performance, a vesting, which has a result also the company performance. So the now ESOP scheme for now, unlike 2018, is directly linked to the company performance as well. That means it also has certain market value reflected in it for its performance.
So you say that there's a performance linked indicator, which is a great place to start. But objectively, how are we measuring this? Like, is it an internal criteria that that we meet X revenue, X? What is it that?
No, absolutely. The companies, you want to answer that? Go ahead. No, I'll just clarify on company. The previous scheme, if you look at it, the 18 scheme was linked on. It is fundamentally it's a loyalty link.
Correct.
I guess it's an entitled one. You hang on for 3 years, every year it vests. You don't care a damn what it happens. It's what it is. The biggest change we have done in this scheme is now it's linked to the organization performance. So it's linked to my performance at my level, quarter on quarter, annually, whatever numbers we say.
So that's what I'm trying to get at. When we say performance, are we linking it externally as to how the market is valuing? Like, because these are the different ones that are followed, right? Like some are based on market cap, some are based on internal targets that we do X revenue or we do X profit margin. Or so that's what I wanted to kind of understand what we are kind of.
Brilliant. When we actually in a sense, it also follows a change in our performance structure and design itself. Till last year, we were only measuring, or a year before, we were measuring only individual performance as the overall performance for individual employee.
Right.
The last year, we made a subtle change to bring a company performance and individual performance as a weightage, right, to define a performance for individual. Right. This year, we have enhanced the scope. We said not just the individual company, there is a medium term called a business unit. It has to reflect. So the group of employees culminating into business unit, group of business units culminating into the company. So we're locking the performance at each level.
Okay.
To measure. Now my company performances are preliminary understanding, it would automatically reflect in my market performance. If I have my margins improved better, my utilization improved better, my quality of revenue is changing, which are my metrics for my MD.
So I'll answer your question from your perspective. Very simple. We are focused on the company's AOP, P&L profitability targets.
Correct.
This year, we didn't want to move to say EPS or market cap.
Right.
Your point.
Right.
But our belief is that this is where we are today, Siddharth. We hit our sustained goals. It is invariably going to impact our EPS and stuff. It's going to happen.
That's
precisely.
That's it.
That I'm glad that at least it's on see, as long as you're linking it to the P&L, it makes sense.
That's correct. It is linked to P&L.
It's not something that.
In fact, so that just to give you reference, even board mandated us before we brought this proposal to do a peer study in that industry. Yeah. We actually did a 6 companies peer study. Okay, and what the kind of ESOP schemes they had. So after much debate on all the peer studies, this is the scheme which has been approved by the board. It is directly linked to the individual performance, respective business unit performance, where the individual sits, and also the company performance on P&L level. Yeah. And that P&L, it is not a pure P&L, it also has linked to the quality of the revenue.
Yeah. But I think the key one, I think the difference between the last scheme and this is, as I told, it is moved from vintage loyalty linked to performance linked.
Correct.
If I summarize very, very clearly.
So essentially, there's no free lunch.
No free lunch.
If you talk about the peers comparison, I would just add here, I think many peers are not granting these all ESOPs on the face value. I think they grant the share on the market price or discount on the market price, I would say.
Yeah, go ahead.
Absolutely.
Absolutely.
No. That also has come as part of the peer study, Harpreet. At a stage where we are in to attract the talent, for now, we thought we will position it at face value. Okay, and looking at appreciation for the employees and employees like the beginning one, which I said, when I'm hiring a talent and also retaining the current talent who are performing critical roles, I would want them also to see the appreciation in their value, which is.
I'll tell you the risk here. I'll tell you the risk here. What others don't have and what 3i would have. You are granting a share and 10 rupees. Suppose tomorrow there is a price, say after a year or so or 2 years or so, price is 100 rupees. People will start selling, but there's no restriction on selling. Am I right?
The vesting is a 3-year schedule, Harpreet. See, when I'm blocking it for 3 years vesting schedule. Okay, so employees, if I allocate 100 units of shares, the 100 units gets vested and granted also in year on year.
Well, I think before you joined, Mohan, I think similar thing happened earlier. 3i have allotted a lot of shares, which after allotment, I think days or maybe weeks after, came in as a selling. Am I right, Siddharth?
Yeah, I think we saw this post the reduction of capital when this had happened, and I think slightly just before also. So that was, I think.
No, I'll answer that. See, I think we should talk on. See, these are 2 separate stuff. Okay. Now, in the current scheme, no way the guy can sell.
No way, okay.
It's a piece of paper. Okay. It's a grant. 33% vest every year, let's say, for example. It gets vested in 1 year. Now he has to decide whether he has to pay the,
the face value and then
exercise, or he will retain it, first of all. That's where it is. Okay. Now the event which you're talking, post the capital reduction, what happened was, these were all the Ascensio employees who exited, who were there with the company for 15 years, 10 years, 12 years. They capitalized on it or they sold it. Obviously, they had to sell it. Forget about it. Maybe I would say they were lucky. Okay. They exited 3i. They were with this one and they exercised. If you see all that, it is all the exited employees.
Okay, so
Yeah, so just to assure my investors, there is no right an employee can exercise any of the stock which is granted to them before vesting, and vesting schedule is 3 years, and that is also linked to the
performance. Let's say a scenario happens. Okay.
It's all there in the document.
If you read
I'm just clarifying the entire stuff here.
because of that, checks and balances have been added. To summarize what I'm saying from the learnings from the past also, we've added those checks and balances, brought in a bit of convergence. Sorry.
Mohan, sorry, I have a question here.
Yes.
Yes.
The way I understand now, we are vesting these shares at the face value, 10 rupees. Yeah. So
Correct.
why don't we put a mechanism where we collect from the employees certain margins?
Sorry, Shaju, I missed that question. Margins means, if you could help me understand a bit.
In the sense, we find out the performance to the date they exercise their right, and they become liable to pay a price which is other than 10 rupees. Because we don't want the employee to stand and look at the share price. Is it going up, going down? I take my decision at a later stage. These are a bit, I would say, unjustified benefits, maybe. I would put in this way. Because why should we give so much of time in that matter? Yes, we are giving the share. This is the price. This is the method we have to find out the price at the date is going to vest it, is going to exercise it. Isn't it more just and equitable for shareholders and the company and the employee?
In fact, I have a slightly different perspective on this. I would say that ESOPs being given and employees exercising the ESOPs, holding it, is a very good sign, because that reflects that internal teams are sure that we as an organization are going to do well, and hence the share price will also do well. Why should I sell? I should hold it and sell it when company does well. In fact, I have a paradoxical question. Rather than asking why the ESOPs are being given, I have a question slightly personal to the key management person, but then I think I should ask. I have not seen key management personnel exercising the ESOPs which have been given, because that gives a very good message. Okay.
No, absolutely. I really appreciate that.
If I see, let me complete, Thompson.
Puru, I may answer you part of your question.
I know that 66% of the ESOPs which were granted to you in 2020 are due, but you have not exercised. The day you exercise, I'm telling you, you will give such a fantastic message to the market that look, for himself exercising. So this share is going to go up only. So I have a different question.
No, Purushottam, thanks a lot for asking that. Thanks a lot. In fact, it's a coincidence. I just asked my office. I said, see, I'll tell you, I had a certain principle, Purushottam. I'll tell you why I didn't exercise. I'll give you an example also. I could have done it last year also. I wanted this to happen at a higher rate. Okay, personally, I'll tell you. I didn't want to exercise at the all-time low. Okay, I have some principles in life. I wanted to do it at 60 rupees. I told my EA, don't do it till it comes to 60 rupees. It's a message. It's not that I'm going to optimize on my tax or whatever it is, because that's the values I live. I'm telling you very honestly, because today if I do it, I will save 50% on the tax I have to pay. And you know where I'm coming from. But I take your point. I will definitely do my last year stuff immediately and make that as a clear indicator. So which I'm telling you.
In fact, I'm waiting for it for quite some time.
But, okay, gentlemen, I also want to raise that point. ESOP's pricing needs to be, the granting price needs to be on some sort of a mechanism. Since it is going to be over a period, there needs to have a pricing mechanism. Maybe you can look into this.
I think what he's trying to say.
I understood what Shaju is saying is, year on year, when you see your values increasing, would you like to put a premium on the face value? That's what Shaju is saying.
That's what he's trying to say, because it's related to the market value.
Which is a good suggestion.
It's a good suggestion. Definitely, it's a good suggestion.
Actually, just to add on to what Purushottam mentioned, I think we've spoken about this previously also. I mean, I understand. See, there might be other functions which you might not be, like KMP might not be comfortable telling us why they're not doing. Not necessarily, not out of anything else, but just generally.
Being very transparent. Being very transparent.
No, I'll tell you one thing.
If we can't be very open with you guys, we can't be open with you.
Simple, same question, okay?
Yeah.
What Purushottam is asking, I'll tell you. A banker asked me,
Right.
okay?
Right.
As we now trying to raise, he said, Thompson, please demonstrate this. Because I don't have a promoter.
Yeah, like that's what I'm trying to say. That if the KMP together comes on the press release, you don't even say you don't exercise it. Like what you literally told us, you tell them that we once exercise, we'll hold say 5. I don't know how much the quantum is of MAD. Say let's take it's 5%. Cumulatively, the KMP holds 5% of the company, right? After exercising their as of now what they hold. Make a press release, tell the public that this is what we are planning to do. Once it hits 60, we'll exercise it also.
Yeah.
Like say if you want to do it at 60, not. And I'm glad that you listen to the last
indicator which Thompson is referring to.
Right. I mean, the idea being like, I am not kidding. So we're part, I mean, all of us are part of different investor groups and this thing. There was this entire, and a lot of unfortunately, a lot of our shareholding is retail shareholding.
Yeah.
It isn't in smart institutional shareholding, which can understand, say, the basic difference between unvested, unexercised option and what you actually have exercised and holding shares. There were rumors that we had to quash that, you've bought and you already sold out your shares because shareholding doesn't reflect your name. These are things that we have, I'm telling you.
Valid input. Valid input.
So the moment you send out this message to the market that at least you have skin in the game right now, because there is, this perception that the stock goes up like 5-10%. Okay, this won't go up. Management anyway doesn't hold. They've already sold out their shares. They also don't have trust in this thing, right? So
concern.
Right.
Whenever you exercise, we need to report as per our SEBI insider trading policy.
Right.
Whenever he
I understand that.
sells it.
I understand.
Forget selling it.
I'm talking about a common person. I'm not talking about a person who's well versed with regulations.
No, I agree with you.
So someone who's not reading their SEBI disclosures, someone who's reading at best.
Purushottam was saying something, I think.
No, so I will just add a little to this ESOP thing, and then we should move on to other things also because are more critical. So the last point I wanted to mention about ESOPs is somebody mentioned that we should give it at a higher price, etc. See, I have myself enjoyed a lot of ESOPs in my past. Let me tell you, when you take ESOPs at a much higher value, then there is a perquisite tax also a person has to pay. So today, if suppose the price is say around 38 rupees, you're talking about 10 rupees vesting. So 28 rupees is the benefit, but out of that 28 rupees, he'll have to pay say around 30% perquisite tax. So if you try to increase the ESOP transfer price, the attractiveness of ESOP itself will go. So I don't think you should fiddle around with that. I would rather say give ESOPs, do better, let the price go up, let everybody become rich. Employees,
that's the precise direction which we wanted to push. That's the reason we're not calling out performance for EPS. We don't want to put that. Some of the companies which we reviewed actually put EPS and their stock price is pretty low for last 10 years. So we've seen those indicators. We said we'll not put EPS as a metric. Absolutely.
Yeah.
So besides that, Thompson, I have 4-5 questions. If I can go in one go and then maybe you can answer it one by one. That's fine.
Thompson, I'm going to respond to your first question. I told you I'm going to act on it. You'll see it immediately. Quickly.
Great. I'm telling you, Thompson, I've been waiting. I checked personally I would say annual report to see when is it that shares of Thompson's are due. And then I realized that May 2023, 60% is due. And I've been waiting for it.
Okay.
You're doing it. Okay. Okay, great. See, I have 4 or 5 more questions related to business. One is I wanted to ask you, why is it that we are not going for the currency hedging? Because we have seen last quarter, we had an adverse impact of say around 5% on our profitability because of currency exposure, fluctuation, exchange fluctuation. And prior to quarters, there was a positive 10%, but that adds to the uncertainty. So one is that point. Why is it that we are not going for the currency hedging? That's number one. Number two, see, I'll tell you, when I studied 3i initially, what I found is that there is a huge amount of gap between 3i and the peer levels in terms of per person revenue productivity. And that is where the game lies. I thought that this organization today operates at around $15,000 per person per year, whereas your peer level is operating at around 45 odd. Even if you are able to bring it to somewhere midpoint, we are talking about a market cap which can go up by say around 2x or so. So I have not seen that per person revenue productivity per year going up in that direction. So that's another question I wanted to ask. What is the path we have? How are we going to achieve that? Third, I wanted to ask is, we had a chief growth officer who was supposed to drive the charter of growth for global geos. Our revenue mix being 50 India domestic and 50 global. Whereas if I compare it with competition, it is say around 90 odd % global and 10 odd % or maybe single digit domestic. And all of us know that margins are much better. At the same time, revenue, I would say, which is available global arena is much better. So what is the plan we have since the chief growth officer has moved to some project? Do we have somebody else replacing him? Or what are the plans we have in terms of growing the global geo? Because I think overall margin as well as the revenue, we can really ramp up numbers if we do much better in the global. While we are doing a great work in domestic business, we have seen so many wins coming, Railtel, etc., etc. But global is where I think we would like to understand from you what is happening there. Yeah, and last question. See, I will take an analogy with the game of cricket. If you have to attain a run rate, you have to in some over come to the required run rate, so that then on you can score that required run rate and win the match. We have $1 billion at 2030. If I look at from today, we require 35% plus CAGR from this year. Now, are we, I mean, this year going to hit that? Or the next year, it may go up to say 40-45%. So somewhere, I think in some year, we'll have to hit that required run rate of 45% CAGR or 35% CAGR if this year, or going forward, it will further increase. So I wanted to understand, are we saying that this year we'll get to the required run rate? These are the questions I have.
Thanks, Purushottam. All great questions. I'll try and answer one by one and also get other colleagues. So one is on your question on Chief Growth Officer. Sachs Krishna is on the call. Sachs used to be the Chief Growth Officer. We have given him a more additional portfolio right now. You know, he's become the global COO for the value business. Anyway, I will come to that question. And plus, we have also roped in a Chief Sales Officer who works very closely with Sachs and me. Both of them are American citizens. So on a lighter note, I have a younger Sachs also. So we'll talk about that, you know. So when Sachs talks about it. I'll come to the first question. But unfortunately, Sanjay is on a personal vacation. Didn't want to bother on the. I agree with you because the currency fluctuation was a variable for us. We had the windfall and the flip side, and now definitely we are trying to make it in a more predictive model, if I may put it that way. But I'll probably get Sanjay to maybe, I don't know, answer it later on. Maybe we'll send you a small note or whatever, you know, in terms of how we are trying to do that. But we are wary of it, and we want to keep that variability as limited as possible, Purushottam. So in fact, we are already doing some models for our Q1 and, you know, looking at it on a variables and what will impact and all that stuff. So we're kind of learning as we are, you know, so we're getting more proactive. That's what I can assure you, you know, on that. But I will come back to that very specifically. Let Sanjay answer that for you, you know, formally. Maybe Valika, we can respond to that. It's a fair question, and we should do that. The second question you had was on, sorry, one was on hedging. The second.
Growth officer role.
No, that was the third question.
Per person revenue productivity.
Yeah. The per person revenue, Purushottam, I think, see, the whole aspect of where we are and where we want to get to, Purushottam. Okay. Just to refresh our memories also, you know, if you look at it, when you compare peers, I've always told this consistently in a lot of meetings where we had before. Typically, you take any of the Indian IT services companies globally, it is 80-20, 80% of the employees sit in India and 20% are onshore, if you look at it from a revenue contribution perspective. And that's a good old model. I've been part of it. And I keep saying, you know, all of us have done our CV saying how many jobs you built in India, you know, moved to India, all of us, everybody, all of us have done it in our past lives. Now, unfortunately for us, our mix, what we inherited was totally different. If you look at a revenue mix perspective, and a margin related to that, if you look at it, though our 50% revenue comes from US, if you look at it, 80% of that revenue is contributed by some 150 employees in US or whatever it is. So you look at it, what I'm trying to say. So fundamentally, the revenue mix for us is very skewed. So the offshore base is extremely small, Purushottam. That's a problem statement, what we have. Now, what we all inherited as a team, and we are running to it. Now, where we are right now with the macroeconomic changes which are happening, two things are happening very clearly, which I can assure you. There is one group which wants to leverage the Indian offshoring story. There is a market for that, and we are working on it, and where we are getting more aggressive in terms of offshore, rates where we can be competitive with any of the peers which you're talking about. We can get that rates for us, easily, like what you said, 1,500 or 2,000, aram say 24,000 per annum will come very, very, not very easily. I say, even if I'm kind of in a very aggressive pricing models, we can do that. Okay, that's point number one. There is also a very clear mark which is happening where they are saying, I don't want India. Very categorically. Okay, they are saying, can you do business in America, period. Now, that is where you bring all your technology and all that stuff. Because if I'm going to just do an America domestic business, again, your margin will be like another India business. So that is where some of this generative AI and all this new stuff has suddenly opened up a different option. In fact, the last 2 quarters have been very extremely, it's an inflection point for the industry. Now, what we were trying to sell and people were not receptive to buy, and now they are asking, and also coupled by the recession winds in Western world actually. So now onshore, which is digital, automation-led, cognitive powered business is a reality. So for example, if you need 100 people to do work for a particular project, 20 sitting in America and 80 sitting in India, you can do the work with 30, 40 people onshore itself, powered by technology, or 30 people, and still make more or less similar margins, not at the same levels. So that is the trend which is happening very, very clearly. And the advantage for us, Purushottam, we have got nothing to lose. Unlike other peers, if this boardroom or some other peers, all of us will be saying, how will we cannibalize our business in Bangalore, Hyderabad, and Chennai? That will be the debate which will be happening. For us, we have got nothing to lose. We are going very aggressively in that model in onshore. So I'll allow Sachs to expand on the third question you talked about, the global business and how he's shaping it, because it will now get into that particular question which you asked. And maybe Sachs, can you please help me out on that, your plans of how we are trying to expand the US and the UK and other countries, Sachs.
Absolutely. First of all, thank you for that question. Not many people ask this question because it involves certain amount of strategy that we put in place as we started this journey 2 years ago and where we are today. So when we came on board, Purushottam, Thompson, maybe 2 months before me, we were just given what was the residual business, right? With some, like anybody else, somebody did a sell job on us, and I don't blame them. It's, the natural way of human beings. Now, when we got into it, we also made a statement to the market and to the shareholders that we will not go again borrow money to grow. We said our run, we will squeeze our operations of the run business and grow it incrementally and use that free cash flow to fund the build. So obviously our transformation strategy was dependent on building new capabilities, new competencies. Because as if you've been, obviously you're investors in the company for a long time, you would have noticed that there was not that much focus probably given to building new competencies and capabilities in the services business. So we had to do that, right? So the hypothesis was that our current operations are quite good, they're well run. So we don't have to pay much attention to it. And we can start building, releasing more cash flow and putting it on build and start using that to accelerate our penetration and our revenue mix change across the globe. Now, naturally, what has happened as we got and tried is that our current business needed to be fixed and ring fenced and protected and transformed, and all the baggage that we had because of old 2 decades of employees. So all that took some time. So we shifted right. No questions. It is very evident from the performance that we shifted right. But that's also helped us. That's also a blessing in disguise, because as we came out of pandemic, all of us took over this transformational journey at the end of pandemic, right? In fact, I don't think we met as a management team till about 3-4 months after we came on board. We only met on Teams and Zoom calls. But that aside, so the pandemic helped us in terms of coming out what the models were. For example, shifting from India-based export to within country, service delivery. That was becoming more and more of a not just a desire, but a need. If we had started our journey thinking that, again, the pyramid model, we're going to put everything offshore, we probably would have not been in this place today to take advantage of this shift. So a blessing in disguise. So, and meanwhile, we've also spent that, it took us a little bit more time. We've got all the build initiatives in motion now. In motion meaning they're already going to market. We've already seen customers signing up for it. Obviously, that hockey stick is going to take. It's not a hockey stick. Obviously, it's a gradual stick that will show results as we go along. Our penetration and our strategies in each of the regions, and each region is a different. We're also, for a young company like us, I truly believe that we're in far too many regions than we should be, but that's an advantage and a disadvantage. The advantage is we're already there, so we should leverage that. UK, for example, has got a totally different strategy. Middle East, for example, has got an existing business as a different characteristic, and therefore the growth also has a different strategy. US at the same time has a different strategy. Let me go through each one of them very quickly, so in a minute or so you get an idea. Let's take UK, for example. That's our newest geography. If I say newest, we were there before as old 3i, but after Essentio, we became minimized in our presence in UK. So it's a restart for us. It's a rekindling of the candle. What are we doing there? We are very, very focused. We've got a very strong go-to-market and a front-end consulting delivery partner with whom we are doing three things. One is we are focusing on healthcare, and there we have already inroads into their NHS system. We are focusing on higher education, because that consulting company already has inroads into almost every higher education institution. If you remember, we had already bought a property called Nure Campus or Campus Labs, which was a university ERP product, so that could have been deployed there. So we have a product ready, and we have a market ready, and we have a GTM team ready connecting with that. So it will show quick results. The third area will focus on state and local county government. So maybe it's less of it, but public sector is a big business in UK. So that's a UK strategy. If I move across the pond to US, none of these strategies will work in the US. US strategy is all about BFS, because we have the pedigree, we have the knowledge, and we should be able to leverage that. So in US, we are focused because US is too large a geography. If you really want to cover US, your sales costs should go through the roof. That's another problem. We are also trying to manage our sales costs within the regions, across the regions, and so on and so forth. So you do the balance act, you realize that we need to focus on something that we can quickly get traction on. So we've focused on this thing called mid-sized banks, because they are not being serviced well by the tier 1 companies. Credit unions, for example, which is nothing but cooperative banks of India, if you just translate them in the US. We've got a nice mosaic of offerings. We've got inroads. We've got an existing referenceable customer. So we're using that to propel the US strategy. So all that took time to put in place. You should start seeing results in the short course.
I just wanted to add a point here. What I've been reading is there is a consolidation of smaller banks in US that is happening. Maybe not just the smaller banks, mid-size also. The larger ones is where the portfolios are moving. So is our strategy in line with that new challenge which is coming for the smaller and mid-sized banks? We have seen, recently you would have seen a lot of smaller banks because of the interest rates going higher, etc. Getting closed down. So I don't know if we have taken into consideration that aspect.
Maybe one liner, and Saxi can pick it up. We went through that strategy, Purushottam. Where we are doing our sweet spot is credit unions. Credit unions are, how do I say, guaranteed by the governments. Fundamentally, our focus is on the credit union family. And also in the financial services is on payday loan and all the stuff. If you look at it, we are very, very focused in that area. Saxi, back to you.
Yeah. So again, good observation, Purushottamji. What is happening is the for-profit banks are getting into trouble because of oversized loans or exposure on NPAs and getting gobbled up, because by design or by force, they're getting gobbled up. There are other for-profit mid-sized banks who are being gobbled up just because of market share and CASA account share. Whereas if you look at the credit union, they are kind of roll-up agnostic. They will roll up only amongst themselves for one fundamental reason, that they are non-profit. The behavior of these banks do not really match the cultural mindset of the employees in the business, do not really match the for-profit. The for-profit are considered to be vultures in their language, and credit unions are the saviors of the community, right? So you will not find credit unions getting gobbled up by either mid-size or large banks. What will happen is smaller credit unions getting conjoined with a bigger credit union, so you get a bigger. That's perfect for us. That's perfect for us because we'll help them consolidate. because they're in the same ecosystem. So that's a positive move for us, if you may. And we are seeing that. We are seeing that smaller credit unions are talking in terms of how they can emerge and co-emerge, and we are in the conversations with them because a lot of IT reconciliation needs to happen. A lot of redundant assets need to be optimized. So we do all that from a offering perspective. So I don't know if I answered your question, but that's what's happening in our market space.
Yeah. So just to summarize that question, Purushottam, to the point on global, I think Purushottam is frozen, I guess.
Yeah. Let's just come back.